How to build a retirement fund with smart investments. Did you know that nearly 40% of Americans have less than $10,000 saved for retirement? That's a startling number, and it paints a worrying picture of what many might face when it's time to retire. But here's the good news: it's never too late to start. Even if retirement feels like it's years or decades away, the choices you make today can have a huge impact on your future. Imagine retiring without worrying about how to pay for your bills or your healthcare. What if you could live comfortably, travel the world, and focus on things you love without the stress of financial insecurity? Building a retirement fund doesn't require a big inheritance or a massive paycheck. It all comes down to starting early, being consistent, and making smart investment choices. In this video, we'll walk you through exactly how you can build your own retirement fund, step by step, with simple yet effective strategies. Whether you're just starting out, or you're well into your career, the right choices today can help you secure the financial freedom you deserve when you retire. Stay with us until the end as we break down how to make your money work for you and how smart, steady investments can build a robust retirement fund. This is not about getting rich quickly, it's about taking slow, steady actions that pay off in the long run. 1. Start early, even with small contributions. The most important thing when it comes to building your retirement fund is to start as early as possible. The longer you wait, the harder it is to build up the amount you need for a comfortable retirement. Even if you're just beginning your career or if you're in your 30s or 40s and haven't saved much yet, it's not too late to start. One of the biggest advantages you have when you start early is the power of compound interest. Compound interest essentially means earning interest on both the money you've saved and the interest that money has already earned. The earlier you start, the more time your money has to grow. For example, if you begin saving $200 a month at the age of 25, and you invest that money in a fund that grows at 6% annually, by the time you're 65, you could have over $300,000. However, if you wait until you're 35 to start saving that same amount each month, you'll only end up with about $190,000 by age 65. That's the power of time. The more time your money has to grow, the more you'll accumulate by retirement. Even if you can't contribute much at first, starting with small amounts adds up over time. Don't wait until you can afford to save more. Start today, even if it's just $50 or $100 per month. As you earn more over the years, you can increase your savings. 2. Choose the right retirement accounts. When it comes to saving for retirement, it's not just about how much you save, it's about where you save it. Choosing the right retirement accounts is critical because these accounts offer special tax advantages that can help your money grow faster. The two most common retirement accounts are 401ks and IRAs, individual retirement accounts. Here's what you need to know about each. 401k plans. If your employer offers a 401k plan, make sure to take full advantage of it. Many employers match a portion of your contributions, meaning that for every dollar you put in, your employer may add another dollar, up to a certain limit. This is essentially free money. Don't leave that money on the table. In 2025, the contribution limit for 401ks is $22,500, which means you can put up to this amount into your 401k each year, if you're under 50. If you're 50 or older, you can contribute up to $30,000, thanks to catch-up contributions. If your employer matches your contributions, this is an incredible opportunity to build your retirement fund faster. IRAs, individual retirement accounts. An IRA is another option that allows you to save money for retirement with certain tax advantages. There are two types of IRAs, traditional and Roth. With a traditional IRA, your contributions are tax deductible, meaning you won't pay taxes on the money you put in until you retire. With a Roth IRA, your contributions are made with after-tax money, but the money grows tax-free, and when you withdraw it in retirement, you don't pay taxes on it. In 2025, you can contribute up to $6,500 per year to an IRA, if you're under 50, or $7,500 if you're 50 or older. Even though the contribution limits for IRAs are lower than for 401ks, they still offer a great opportunity to save for retirement and take advantage of tax benefits. If you don't have access to a 401k through your employer, an IRA is a great alternative that's easy to open and manage. You can open an IRA at most major financial institutions, like banks or brokerage firms, and it only takes a small initial deposit to get started. 3. Diversify your investments. One of the most important principles of investing is diversification. This simply means spreading your money across different types of investments to reduce risk. Instead of putting all your money into one company's stock or one type of asset, you should spread it out over a variety of investments. Why is this important? Well, different investments react differently to market conditions. If one asset is performing poorly, others might be doing well. For example, stocks might be down, but bonds could be up, balancing out the overall performance of your portfolio. By diversifying, you reduce the risk of losing everything if one area of the market drops. When it comes to retirement savings, a well-diversified portfolio usually includes a mix of stocks, bonds, and other assets like real estate or commodities. A simple way to diversify is to invest in mutual funds or exchange-traded funds, ETFs, which pool money from many investors to buy a wide range of assets. 4. Invest in low-cost index funds. If you're new to investing, you might be wondering where to start. One of the easiest and most cost-effective ways to invest is through index funds. These funds track a specific market index, such as the S&P 500, which includes the 500 largest companies in the U.S. By investing in an index fund, you're investing in a broad selection of companies, giving you built-in diversification. The best part about index funds is that they typically have low fees. Since index funds simply track a market index and don't require a lot of active management, the fees are much lower compared to actively managed funds. This means that more of your money stays invested and grows over time. Over the long term, index funds have historically offered strong returns, often outperforming actively managed funds. For example, the average annual return for the S&P 500 over the last several decades has been around 7–10%, depending on the time period. That's the kind of steady growth you can expect from investing in a broad market index. 5. Maximize your contributions. Once you've started saving for retirement and are on the right track, it's time to focus on maximizing your contributions. The more you contribute, the more you'll have in retirement, so if you can afford to increase your savings, you should. If your employer offers a 401k match, always try to contribute enough to get the full match. This is free money and an easy way to boost your retirement savings. Once you're contributing enough to get the match, consider contributing even more, especially if your employer offers a higher contribution limit. Remember that there are annual limits on how much you can contribute to retirement accounts. For 401ks in 2025, the contribution limit is $22,500, or $30,000 if you're 50 or older, and for IRAs, it's $6,500, or $7,500 if you're 50 or older. Try to contribute as much as possible without putting yourself in a difficult financial position. By following these strategies, you'll be on the right path to building a strong, reliable retirement fund. The key is to start early, make smart investment choices, and stay consistent over the years. Your future self will thank you for it. If you found this video helpful, don't forget to give it a thumbs up, share it with your friends, and subscribe to our channel for more valuable tips on securing your financial future.